right. We were just giving it a second to let everybody get settled in. And welcome to Tax Tuesday. My name is Tony Covey. I am an EA and Director of Professional Services here with Anderson. I am so sorry, but I am taking the place of the infamous Mr. Toby Mathis today. So you're going to have to deal with me instead. Also got Jeff here, if you want to, well, everybody knows you, but go ahead.
Jeff Webb, CPA and Director of the Tax Department. I'm here all the time. Tony, you've probably seen Tony on Tax Tuesday, and
I've been on a few Tax Tuesdays.
Or not Tax Tuesday, but Tony Talks.
Tony Talks, and if you're a Platinum client, you've most certainly see me on Platinum Office Hour answering all of your questions. Anyway, so just go ahead and get started. It looks like we have some people going ahead and posting in the chat. If you can hear us, type in yes. Yes, yes, yes. Okay, very good. Very good.
You can't hear us, type in no.
Nice one, Jeff. All right, so to get started, we'll go over some of the Tax Tuesday rules. You can ask live questions via the Q&A feature in Zoom. It looks like some folks have already started doing that. You can send in your questions at taxtuesday@andersonadvisors.com. We go through those questions and we'll bring them to you every other Tuesday, and we'll answer them here, as well as answering your live questions. If you need a detailed response, you will need to become a Platinum or a tax client. If you have someone asking, what is Platinum Office Hour? If you're a Platinum client, we have a daily Zoom meeting for all of our clients who like to attend from 4 to 5 Pacific, and they come in and ask any of their tax or asset protection questions with us. We're always manned with one of our attorneys and one of our tax advisors for you. This is a fast, fun, and educational format. We want to give back and help educate. We consider ourselves an education company first.
And if you're going to ask questions, make sure you do it in the question side, not the chat side. We will attempt to answer all of the questions, but if you ask a question in our chat, it's likely not to get answered.
Right, very good. All right, so we'll go over some of the questions that we're going to be answering for you today. And that is, I have 3 different businesses and plan to add more. How should I pay myself from each one for maximum tax benefits? I'm on a payroll and receiving a K-1 for each company, but my tax debt is stacking up. I also try to purchase more property or refinance some of my other ones, but at times my debt to income ratio interfere with the process. Now, I thought that was shorter. I think Toby is messing with us. We'll answer that. Do wholesalers of land need to pay self-employment tax? That is a short one, but that's a good one.
Mm-hmm.
We'll answer it. To maximize tax benefits as a realtor, is there a catch to it being your full-time, I'm going to go with full-time, business? I have a salary job that I rarely work more than 20 to 30 hours a week and do a realtor business as well. Is there a catch that limits some tax breaks? I'm going to say for real estate, or if real estate isn't considered my main job? It's a very good question. We'll answer that. Could you please review how LLCs can work with 501c3s for both to maximize benefit? The LLC being a for-profit and the 501c3 being nonprofit. How can they interface without violating any tax codes? The disqualified person and prohibited transactions and self-dealings just pop into my head, but we'll go over that. If I run my real estate business from my home, can I deduct a portion of all home expenses, i.e. property tax, utilities, insurance, etc.? Toby would love that one.
Mm-hmm.
We'll go over that. Startup S Corp has no revenue yet. If I file taxes jointly with my husband, any concerns? Smooth. We'll go
I
over
like the
that.
extra commas you put in there.
What is the best way to pay your children, teenagers, good, so they can hold something, when they work in your business? Payroll, cash at time of service, then year ending, I'm going to say 1099. We'll answer that. I reimburse myself for my health insurance premiums through my C Corp. My fiance and I are planning to get married later this year, Mazel, and I will become eligible to get my health insurance through her employer. Is it permissible to reimburse her for my portion of the premium through that same C Corp? This is an entity that was set up by Anderson Advisors. Good call. We'll answer that.
Good question.
Can you explain how to invest in stocks from an LLC and how it is beneficial on taxes? What are our write-offs if we are investing in stocks? Trick question, right? Yeah. We'll answer that. Can I use an S Corp to serve as a management company for my real estate investment if the real estate is held by my Wyoming holding and Illinois single member managed LLC? Are there any tax benefits to this strategy? We can make some. We'll answer that. If I have an S Corp, can I use a combination of Section 179 and 168K for equipment or business vehicles? Jeff will answer that.
I will do so.
Is it better to file married jointly or separately? Or separate? We'll answer that. Is it better for a single member LLC to file taxes as a disregarded entity or as a partnership, and why? We'll answer that as well. These are some fantastic questions. All right, we're hopping right in, folks.
Yep.
Seems like. All right, so
we're going to answer the one Toby threw in there.
I think Toby did some adding on here. Okay, so I have 3 different businesses and plan to add more. How should I pay myself from each one for maximum tax benefits? I'm on payroll and receiving a K-1 for each company, but my tax debt is stacking up. I also tried to purchase more property or refinance some of my other ones, but at times my debt to income ratio interfered with the process. So I think we're going to have to approach this in some bite-sized pieces, because the part of this that sticks out to me is obviously we don't have any specifics. We don't know what kind of businesses these are, what kind of entities they're in, but the clue, the breadcrumb I can see there is I'm on payroll and receiving a K-1 for each company. All right, so in order to be on payroll and receive a K-1, you're gonna have to be an S corporation.
Correct.
If you're a partnership receiving a K-1, you are not an employee, so you would not receive a payroll, W-2.
And I'm assuming that they're investing in rental properties, especially since they talk about they're trying to buy more properties and they have problems getting additional financing to buy more. And we see that sometimes, especially if you're very leveraged, it becomes more difficult to get additional loans, even though you're still securing the loans with those properties.
Right.
And the bank's main concern is, can you make the payments on these loans based on your income stream?
Right. So debt to income ratio, then we're talking about you've got a balancing act issue is what's happening here, because in order to get that debt to income ratio to be what a lender would want it to be, you're going to have to pay yourself payroll, right? But you pay yourself a payroll, and the payroll is going to increase that tax that you're talking about that's stacking up. So you actually have to look at it and go, which one is going to be worth it to me? Because we can't, on the one hand, I guess, omit deductions
Mhm.
so that we have a higher net income to show the finance company. And then also, go on the heels of that and add deductions so that we don't have that tax burden. One thing, since it looks like what you have is S corporations, maybe 3, maybe not, is you might look at doing a C corporation, because a C corporation allows you to have a lot more control over what income is going to be on your personal tax return versus an S corporation where all of the income is going to flow through to your personal tax return. And what you're in control of there is how much of it you're going to pay payroll tax on, right? So you can control how much you're going to take out of the S corporation as a payroll versus how much you're going to take out of the corporation is what is referred to as a non-dividend distribution.
Mhm.
All right. So ultimate question here seems to be, how should I pay myself from each one for each one of the different businesses for tax benefit? It really and sincerely depends. We simply don't have the information in this question. But if we are talking about an S corporation, as I assume we are because we're on payroll and we're receiving a K-1, is you really just have to look at making sure you're only paying yourself a reasonable salary. You're not paying yourself more than that, subjecting yourself and your S corporation to increased payroll taxes. And then after that, it's a matter of doing reimbursements from your S corporation for your out-of-pocket expenses. Maybe the 280A meeting room deduction is a way you can get income out of the S corporation tax-free. So there are some options in doing that, but it's going to have a lot to do with tax planning.
Yeah, and it all goes back to what you said originally with, this is a fine line you're walking. You can either have good income for loan purposes or good or bad income, lower income for tax purposes.
Mhm.
And every time you come up with an additional deduction, you're kind of hurting yourself on the loan side.
Correct.
The good news is, since this is an S corporation, lenders tend to take more into account for the income coming from those. If these properties were just owned in your name, they tend to only acknowledge about 70% of the income coming through from the individually owned. So possibly what you may want to do is build up a war chest. It may take you a year or two before you can make your next move. And we do see this fairly often with people who are highly leveraged in properties,
Mhm.
and they can't pull the trigger on the next property.
Yep.
One thing you may want to consider, unfortunately, this usually only affects 1 year, is the old cost segregation,
Mhm.
where you're going and cost segregating those properties. You're going to take a hit on income in 1 year, possibly be able to roll it to other years, but that'll be another question you have to answer with lenders on why your income's so low.
Well, but you have more control over that too.
True.
Than people are led to believe at some junctures. Everybody gets very excited about the cost segregation. I don't blame them. I do too. But the piece of it that they get caught up on is the bonus depreciation, which we're going to talk about later, in that we can go ahead and reclassify in a cost segregation all of these expenses that are not structural components, and we can accelerate them and deduct them all in the first year. That's true. There's no falsehood there. But what you've done is you've taken out your structural components and reclassified them as personal property, which is going to be depreciated over shorter periods, so 5, 7, 15 years. Nobody said you have to take the bonus depreciation and put them all in the 1 year. Look at it and see, maybe you just take the 15-year property, or maybe you just take the 7-year and leave the 5 to depreciate over that 5-year period, so you can spread out that benefit, but at least it's not 27 and a half.
And if you have 3 businesses all with real estate in them, you don't have to cost seg every single one of them this year. You could do one this year, one next year, 1 year after that. So you're kind of spreading out that
The
deduction.
love, yeah. All right. Anything you want? Anything else you
No, I
want to-
think I've said enough.
We've done that question to death. Okay. All right, next one. Do wholesalers of land need to pay self-employment tax? Possibly.
Yeah, that's kind of a depends question. I kind of think of wholesaling as you buy the land, you sell the land. You don't do anything to the land.
I don't think of it as buying and selling. You're selling the rights to the contract when you're wholesaling, unless you're a wholesaler that's double closing.
Okay.
I'm going the way of, it can work out both ways, but at the end of it, the income we're talking about, whether you're using a wholesale trust, whether you're doing a double close, which by the way, I typically recommend, I should say, going the way of the wholesale trust, because the double close can hit you with additional paperwork and expense, but it's deductible. At any rate, the income earned through wholesaling is going to be from a fee, almost like a finder's fee, right? So that is going to be ordinary income. The question is, are you doing it in your personal name?
Mhm.
Are you wholesaling in your personal name? If you are double closing, you're buying and selling real estate and you're doing that in your personal name, what comes next? Dealer status, which we don't love, because that comes with a whole host of other problems. But let's just roll back to the actual question. Do I have to pay self-employment tax? Yes, reel me back in. I've been hanging around Toby too much. Do I have to pay self-employment tax on it? It depends on if you're doing it in your personal name or if you are doing it in LLC taxed as disregarded, meaning in the eyes of the IRS, it is non-existent and it is simply reported on your personal tax return. In that event, yeah, it's going to be subject to self-employment tax. However, if you are wholesaling, which we would more so recommend in a corporate entity, be it an LLC taxed as a corporation, be it that you've left it a C or you make the S election, that way you do not have to pay self-employment tax. If you're a C corporation, obviously C corporations don't pay self-employment tax. If you're an S corporation, the income flowing through is not subject to self-employment tax. However, you are going to have to pay yourself a reasonable salary, which people get tripped up on a lot on, because IRS is so good at explaining things like reasonable, right?
Mhm.
To give you a, well, rather, to be more specific, IRS does not define what reasonable means. So we have to come up with what reasonable means when we're using an S corporation. I know that's not the question, so we won't deep dive into that right now, but suffice it to say, if you are wholesaling, that is going to be ordinary income. So if it's reported on your personal tax return, it is going to be subject to self-employment tax. What's the answer to that? Don't report it on your personal tax return. Just leave it on. No. Put it put it in a corporate entity so we can avoid all of that madness. Anything you want to add to that?
Nope.
All right. All righty. Next one. To maximize tax benefits as a realtor, is there a catch to it being your full-time business? I have a salary job that I rarely work more than 20 to 30 hours a week and do realtor business as well. Is there a catch that limits some tax breaks if real estate isn't considered my main job?
Okay. No, I mean, there's really nothing I'm aware of just because you're a realtor. I mean, lots of people are realtors as a second job.
Mhm.
I think what we might be confusing is real estate professional versus realtor. With a real estate professional being somebody who's in the business of renting out properties to others.
Right. I picked this question for the very reason that you're getting into right there, is there is the confusion of qualifying as a real estate professional per IRS definition and being a realtor. So you actually don't have to have a real estate license to qualify as a real estate professional per IRS, right?
Mhm.
It can help. And I know that we have a lot of people who invest in real estate who like to have their license so they have access to the MLS.
Yep.
But you don't have to be a realtor to qualify as a real estate professional.
Right. It is helpful
Mhm.
because especially if you spend a lot of times doing real estate, that you can make yourself a real estate professional. But also, one of the issues with being a realtor in many states is they have to be a realtor in their name,
Mhm.
which means they're subject to self-employment tax, what we were just talking about in the
Right,
last slide.
right.
Um, If you can, I normally suggest that you try to be a realtor through an S corporation. You sometimes have to, certain states make you register that entity as a brokerage, not just a real estate company. So again, this is something you have to check on state by state.
Yeah, yeah. And to your point, there are certain states, and I've seen it in states where it's allowed for you to receive your real estate commissions through the S corporation, as long as the 100% sole owner of the S corporation is a licensed real estate agent, and the broker still refused to pay the S corporation because of their understanding and interpretation. That's okay. There's just extra steps we have to go through to work around that, and we do have those extra steps for you. But in this one, they say I have a salaried job and I rarely work more than 20, 30 hours and do realtor business as well. So let's assume there that this salaried job has nothing to do with real estate. But if it did, and is it more than 5? You have to be a more than 5% or 2% owner to be able to count that in your real estate professional time. Do you remember?
I do not remember.
I want to say 5%. As long as you're more than 5% owner in that business and it is related to real estate, you can actually still count the time during that salary position in your hours for real estate professional. What am I talking about when I say hours for real estate professional? Well, in order to qualify as a real estate professional under IRS terms, you are going to need to meet 2 tests, one of them being a 2-prong. First one is material participation test. And I believe that's like 7 different tests that you can meet, but there's really only the 3 that really stand out. And that's the more than 500 hours in real estate. And you can do that with aggregating. There's the more than 100 hours in significant participation or something like that. And then there's the no one else spent more time than me on the activity to meet material participation. It's 1. And then the second test is 2-prong. It's more than 50% of services performed in real estate and at least 750 hours logged for real estate. So when you marry those 2 things, more than 50%, if I work 750 hours W-2, I have to have 751 hours logged, right?
And let's use this example where she's working 20, say she's working 30 hours a week. She's going to have 1,500 hours at the end of the year. So you have to have more hours of that in your real estate activities than what you have in your non-related job.
And you can include, if you actually are a realtor, you can include that time when you are logging these hours, as long as you are a more than 5% owner of the real estate business. And if you're a realtor who's simply receiving a 1099 for their commissions, then you're a sole proprietor.
Yep.
So
you are the 100% owner of your business.
Exactly right. Is there a catch that limits some tax breaks if real estate isn't considered my main job? Okay, so that's the whole point, right? So if you can qualify as a real estate professional, that takes your income or loss, I should say, from the real estate activity from being passive to being non-passive. And non-passive losses, unlike passive losses, are deductible against your ordinary income. So that's the real rush and the reason why you want to qualify as a real estate professional. So there is maybe a considerable tax break for you. If you're experiencing paper losses, especially with the cost segregation, if you can qualify as a real estate professional. They're just smashing through the questions, aren't
I
they?
just noticed that there, we do have a number of people, Pio and Tax. I think Christos is helping out, Elliot, from your department, one of our
One
tax
of my guys,
advisors.
so you can trust him.
Tavia, I think, is on to help with bookkeeping, and who am I missing? I know I'm missing somebody. If I'm missing, I'm thinking of you.
You're in here. All right. Let's see what we got here.
So Toby has just put out this new book, Infinity Investing. If you've been on Tax Tuesday before, you've heard him talk about it. Infinity Investing is Toby's get rich quick book, right?
Mm-hmm.
Yeah, it's
Yeah.
it's absolutely not that.
Get rich slow.
Get rich slow. It's about smart investing, building up, like I like to say, your war chest. So it becomes impossible to spend the cash flow without a really bad drug or gambling habit.
Okay.
Okay.
So what I can tell you is I actually did attend the very first Infinity Investing, and that's contains a lot of what's in this book.
mhm.
And when I tell you, it completely changed the way I thought about like net worth and things like that. And you know, the power of passive income where you can get it. So yeah, you guys might want to check that out.
And there is the link for aba.links/infinity book. Did I say that wrong?
Yes, /
// I haven't gotten that right in 20 years.
All right, back to the questions. Could you please review how LLCs can work with a 501c with 501c3s for both to maximize benefit? The LLC being a for-profit and the 501c3 being nonprofit, how can they interface without violating any tax codes? Very carefully, no. So I guess it really depends on what kind of LLC we're talking about and really what it is you're trying to accomplish by moving the funds out of your nonprofit into your for-profit.
Mhm. So let's start where we usually see LLCs working within the 501c3. Say if the 501c3 is doing affordable housing or things of that nature, we may put 1 or 2 or 3 LLCs in there to protect the properties from each
So
other.
LLC is disregarded to the 501c3.
The 50, yes, exactly what she said.
All right. And you got to be careful with that too on a state-by-state basis, because not all states, I should say, allow the disregarded LLC to benefit from the 501c3's tax free status, tax exempt status. Texas being one of those states, we had one where we had several LLCs disregarded to a nonprofit, and then we had to go in and get the exempt status for every single one of those disregarded LLCs. So you want to be careful of that and make sure you're working with a nonprofit specialist when you're setting these kinds of things up, these kinds of structures up.
Now, as far as a for-profit LLC that is maybe disregarded to you or that you have ownership in, working with a 501c3 that you set up and you donated money to can be a really iffy proposition. Like you said, it depends on what the relationship is. What are they doing? If the LLC is a real business and they're selling stuff to the 501c3 at fair market value, what they would sell to the public for, that's one thing. It's when you start getting into bargaining issues where you're lowering offer price or lower prices, or worse, even higher prices to the 501c3 maybe to get a bigger deduction or whatever, that it can really be a problem.
Yeah. I mean, I suppose if the LLC is not a related party to the 501c3, then you could contract that LLC for services. And the 501c3 would be able to pay the LLC for services. I find no difference in that from just paying yourself a salary for working for the 501c3, especially if the LLC is a disregarded entity.
Yeah,
To you personally, I
an
should say.
important rule is to remember is arm's length transaction. If it's between the LLC, for-profit LLC, and your nonprofit, it really needs to be a arm's length transaction, everything a fair market value.
Yep.
If you're paying yourself a salary, it's got to be what is a reasonable salary for what you're doing for the
Exactly.
nonprofit.
Exactly.
We've seen where people will put in $200,000 into a nonprofit and then want to pay themselves a salary of $100,000 out of the nonprofit.
Yeah.
That doesn't really work.
Be problematic.
Be problematic.
So let's go the other way around. And the LLC is making contributions to the 501c3. So that could be another situation. And with that, I would only recommend that you make a charitable contribution from an LLC to a 501c3 if that LLC is taxed as disregarded or maybe a partnership. Because that way it's just going to flow through to your personal tax return and be subject to the charitable contribution limits that you have personally, which
Mhm.
is far more beneficial than the corporate charitable giving deduction, which is what, 20% of taxable income for corporations?
Corporation 20%.
Yeah.
I look to see that drop, but
And well, it's 20% under CARES.
right.
It was 10.
It was 5 and then was raised to 10 and
10.
then 20 under CARES, correct?
But for at least 2020 and 2021 under CARES, we're at 100% of your AGI is what you're able to donate and deduct on the personal level. So you could see the difference there, right? Big difference. So yeah, you can go both ways with the LLC's relationship with the 50, well, 3 ways, I suppose. You can have a LLC that's disregarded to the 501c3 or meaning owned by the 501c3, so you can separate out some of the assets.
Mhm.
You can have a services relationship between the 501c3 and the LLC, or you can have the LLC making charitable contributions to the 501c3, all of which we kind of ran down what the, I don't know if I say we ran down the pros and cons, but touched on.
Now I'm going to change this up a little bit on you before we move on.
No.
What if this LLC is a corporation?
And so what direction?
Either way, but more likely, say the corporation is selling services to the 501c3.
Mhm.
Is that corporation a big enough cutoff between the grantor and the 501c3?
I think so.
I think so too.
Yeah. Mhm.
Okay, you can proceed.
But again, when you say, what if it's a corporation? That's exactly, if it's an LLC taxed as a corporation, that's exactly when we say, no, that's not, you don't want to go the other way, meaning putting money, making charitable contributions from the LLC tax as a corp to the 501c3 because of that 20%. All you get is 20% of taxable income of the corp.
Yeah, I've seen a lot of people make donations through their corporation, especially when it's only 5%.
Mhm.
They make a 10,000 contribution, be able to deduct a couple $100s.
And did not understand that was going to be the case. Someone told
That's
them,
why
oh,
I would
you
have
get up
somebody
to
else
60.
explain it to them.
Well, you get told, charitable contributions are deductible up to 60% of your adjusted gross income. And the thought is that is going to apply to all my business entities and myself. And just for clarity's sake for you guys today, you heard it here first, it's Tax Tuesday. That is not the case. All right, so let's move on unless, Jeff, you want to interrupt again? Or are you good? You're good? Okay.
Confusing lady.
Next question. If I run my real estate business from home, can I deduct a portion of all home expenses, i.e. property tax, utilities, insurance, etc.?
Yes, as the question's written, yes. But there's a couple rules and we talk about home office, we're talking about a Schedule C, a sole proprietor.
Mhm.
So it does have to be exclusive and regular use of that space. And if that's the case, you have a home office, you do all your business in there. It's also supposed to be your primary place of business.
Well, now that's a good question, because what you're talking about is the business use of home deduction that we get to take on
Correct.
our 1040.
Yes.
But we're talking about real estate. Let's assume we're talking about rental real estate.
So we're talking about reimbursements, not home office.
Well, they didn't say they had a corporation.
Okay.
So this is how we work, folks. You guys think you're sending us these simple questions, and we have a million more to throw back at you. So just starting bare bones is where I'm going to go with this, is just face value. I'm running a real estate business from my home. Let's say we're doing it in our personal name. Don't do that. But, and let's say this real estate, and add this fact, I'm adding this fact, but let's say the real estate business is rentals. Now what? Because we're donezo right there. There's no business use of home deduction on the Schedule E, page 1, right?
No, I think in that case, if it was rental properties, that's really when it comes into play. I want to have a corporation managing my rentals.
Yeah, because the rental real estate on the personal tax return is considered a passive activity and investment. So in order to be able to do the business of home, we would have been able to do that in 2017. But in 2018, the Tax Cuts and Jobs Act took our investment expenses off of the Schedule A. So we can't do that. The next option is to do what Jeff was just talking about, and getting yourself into a corporation as a management entity.
So in that case, you're considering your corporation is actually managing the rentals. They could be collecting rent, paying expenses, just managing your LLCs as a whole. And then you can pay that corporation to do that. They can also reimburse you for the use of your office, what we would call an administrative office, not a home office, where the corporation works out.
Yep.
Those reimbursements include the items we have here: property tax, utilities, insurance, numerous other things, repairs, direct expenses to the office.
Now I get this question a lot. Oh, you were getting into the direct and indirect. Sorry, go ahead.
Yeah, direct expenses would be expenses that only apply to that office space. You paint that office, that's a repair for that office. You paint the kitchen, that's actually not a deductible item, period. Things that happen on the outside of the house, your pool maintenance, your house being painted, your lawn care, that also does not get included. But I'm sure we've talked about it in the past, where you calculate all these expenses and then you deduct a portion of them based on square footage or number of rooms or one of the other acceptable methods.
And someone says Schedule E, UBE, unreimbursed business expenses. We are not on Schedule E, page 2.
Yeah, unreimbursed business expenses are from a corporation or S corporation or partnership.
Yep.
Not from Schedule E, page 1.
And one of the questions that we actually get asked a lot is, where are you putting that on the tax return? So I'm on my corporate tax return. I've reimbursed for all of these, the business use percentage of all of my indirect and 100% of my direct. I've given them to you and your team. Where do you put it on the tax return? What do you label it? What do you classify it as?
The corporation side, we usually list it either. You could list it as little as employee reimbursements, or you could be a little more detailed and say administrative office reimbursements, or whatever you feel comfortable with.
I like administrative office. I do. Because it doesn't imply that you're doing rents or anything like that. But I do like administrative office.
So your corporation's reimbursed you $10,000 over the year. Where do you put that on your 1040?
You put it in your pocket. Why are you putting it on your 1040?
And that's exactly right. Reimbursements are not taxable to the recipient.
Yep. So ultimate answer to this question is, yeah, under certain circumstances, you can take advantage of the business use of your home if you're in the real estate business. If that real estate business is active, so it lands on your Schedule C, you're a realtor, let's say, then you would be able to take the business use of home deduction on the 1040. If it's rental real estate, that's Schedule E. You're not going to be allowed that deduction. So we're going to recommend you go with a corporation so you can reimburse. And to the point Jeff was making a moment ago there, and we then in turn make a management fee payment to our corporation, which is a deduction on your Schedule E, page 1.
Mhm.
Oh, right.
I had something else, but let's move on.
Yeah.
I can't remember what it
So on
was.
me to hit the next button. Okay. All right. Startup S Corp has no revenue yet. If I file a joint with my husband, if I file tax jointly with my husband, any concerns?
Do we need a CNI dog or something?
No, not to the dog, but no to the question. Not really that I can think of. Jeff?
The only concern would be is if your husband doesn't know about your S corporation. Might want to tell him beforehand.
Causing some marital issues
Uh,
here.
But I want to go back to the very first part where you say startup S Corp has no income. Because it is an S Corp, it still has a requirement to file return,
Mhm.
issue K1s. It may not have a darn thing on them, but it still has to go through that process.
And it might have deductions, and you're capturing your startup expenses
Mhm.
on that first return. And if it has deductions, no income, you're going to have an S corporation with a loss, which you potentially can take on your personal tax return, depending on what other kind of activity you have. Just keep in mind that with an S corporation, or S corporations are also subject to the hobby loss rules. So we just have to make sure that S corporation has a profit motive. And if you do have losses in the S corporation 2 out of the 5 tax years, it could trigger you for inquiries with the IRS to make sure you are in business with a profit motive in the S corporation. But audits for S corporations are so darn limited.
And she said a profit motive, not profitable.
Right.
You have to be able to prove that you are attempting to make a profit in your S corporation or in any hobby. It's a very subjective test. We always talk about the 3 out of 5.
Yeah, taxable or
3 out of 5 profitable years. That's just one of about a dozen tests that they look at for profitability.
Yeah, they look at a lot of factors, but the 3 out of 5 is just the safe harbor. So if you're profitable 3 out of 5 years, they're not going to look at you.
Yeah, if we applied that to all entities, then Uber, DoorDash, and a couple other, Tesla would have been hobbies for the past 10 years. Or
right. Basically, if you enjoy doing it, it's a hobby. So this is a hobby for me then. Oh, darn. If Toby watches the playback on this, I would still like to get paid for this hobby. Please and thank you. Anything else to add to that one?
Nope.
All right, very good. All righty. What is the best way to pay your children, teenagers, when they work in your business? Payroll, cash at time of service, then year ending 1099, I'm going to go with. Couple things that I will open up with. Glad that you mentioned that as a teenager, because the question that comes up a lot is, what is the age limit on when I can hire my kids? Can I hire my 1-year-old? Can I hire my 2-year-old? There isn't one. You can hire your children to work for the business as long as they're capable of doing what you've hired them to do. So you can't say that you hired your toddler to do, I know you probably wouldn't, but to do janitorial work. You can't hold them up, so I was going to tell a joke there, but I'm going to leave it. So, your teenagers though, I have a 19-year-old and I'm looking at some of this going on in the chat. I have a 19-year-old. She's better at some of this social media and she knows more about a lot of that stuff than I do. So I can hire her to handle my social media marketing, networking, and things like that, setting up my website, so on and so forth. And I could pay her the market rate for those services. All right. So, and then we have people who hire their toddlers, their babies, whatever, as models for marketing materials and such. That's something that the child would be capable of doing. So just keep that in mind when you're going to pay your children. First, you have to figure out what are they capable of doing and what are they going to be paid for doing that. Okay. Now, the best way to pay them, I'd say number one is if you are hiring them through an entity, an LLC that is disregarded to you, or taxed as a partnership with only the parents as the members of that LLC, you can pay them W-2 and they would be subject to
FICA?
FICA and no unemployment on that either, right?
No, I don't think so.
No unemployment on that. I know you don't do the unemployment if you hire spouse or is it siblings?
I'm not sure about the siblings, but I know what you're getting at.
Parents, spouse or parents, you have those. But if it's your child, you're getting around payroll taxes if you're doing W-2 from an entity that's disregarded to you. But you have to do the W-2. So you have to do the payroll reporting. You actually have to run the payroll. Okay. Another good thing when you're doing that is if you pay them under what, like 12,000,
right?
They're not going to have to pay any tax because that's going to be their standard deduction. Now you can even pay them another, what is it, 6,000 for IRA contributions?
If you want to make it traditional, but we often recommend that they do the 12,000, put it all into a Roth.
Okay, you can do that too.
But to your point, if they wanted to put in a traditional IRA, they could pay them $18,000 and not pay a dime of tax.
Exactly. Another way to do it is if you're going to pay them directly from, say, your C or your S corporation. So if you're going to pay them directly from the C or S corporation, they're going to be subject to payroll tax.
Yes.
So you may as well just do it with a 1099.
Now I'm going to object to that because I've been thinking about this.
Okay.
You would think that they would be equal because the payroll tax on one side is going to be the same as the self-employment tax on the other side, correct? Yeah. The one difference is if I'm paying payroll tax on your check, I get to deduct that on my entity. So it does lower the income at that point.
But don't you get the 1/2 self-employment tax on the 1040 as an adjustment to income?
Yes, you do. I really do prefer the W-2s. I think it establishes payroll. Well, it's going to establish payroll taxes either way. Social Security.
Well, here's why I like the 1099. I'm going to tell you why I like the 1099. Is simply because what I can do now for my corporation is I can set up an LLC where my child is the member owner of the LLC and I'm the manager. So I retain control over that LLC and they can't go off spending all of the money that I've paid them W-2 or 1099 on a kegger. I maintain control so I can make sure that they're spending the money. Oh, you can tell I'm a mom. So I can make sure they're spending the money the way that I intended for them to do it. And that way, if I'm doing this, let's say, to help them save up for college, instead of just putting it into a college fund or whatever, I'm going to pay them so I get a deduction from my business. And they have money now in an LLC to pay for their college expenses, the room and board, whatever ancillary expense they may have as it relates to going to school. I retain control of that LLC. That's why I like it. And I also think that the 1099 just makes for simpler reporting.
I will give you that the payroll reporting is a pain, filing quarterly reports and annual reconciliations.
Especially if your child is the only employee that you have. If you have a battery of other employees, and it makes no difference adding one more.
Now, what if I have a C corporation and I'm hiring my minor child, uh, and I'm paying them payroll? If I have a 401k plan, can I bring them into that?
Mhm. As a matter of fact, if you have a 401k plan, did you say if you're paying them 1099?
No, no, no.
Okay, okay. As if you have a 401k and you hire your child W-2, if you didn't offer them participation, that'd be considered discriminatory, wouldn't
Yeah,
it?
well, I know some of the plans have age limitations and such,
Oh, I see where you're going with that.
but I think,
I think you're
I think
good.
most plans, you could still add them,
I think so.
and also add them to your medical reimbursement
Don't ever
plans and
ask
so forth.
questions you don't know the answer to. I only ask questions I know the answer to. All right. Anything else you wanted to add to that one?
No, I've been told not to.
Aw. All right, let's keep rolling. Oh, was that it? No,
Nope.
no. Okay.
Uh, we have a number of different ways to follow Anderson, Facebook, Twitter. Do we have Twitter?
Yes. Yep.
We have a number of different methods. You can see them there all on the slide. Your eyes are probably better than mine. But on social media, we also have, I think we may talk about this later, some of our YouTube and things of that nature. We have tons of material out there for you to look at.
Stay up to date on our upcoming events, webinars, live streams, things like that. Again, we are such an education company. We want to make sure that if we know, you know. So if you follow us on social media, you'll know.
And one of the reasons, frankly, that I like for people to know this stuff is it makes my life so much easier.
It makes for easier conversation.
Yes, it does.
All right, we'll keep rolling. All right, this one looks like a little bit of a mouthful. Yeah. I reimburse myself for my health insurance premiums through my C Corp. My fiance and I are planning to get married later this year, and I will become eligible to get my health insurance through her employer. Is it permissible to reimburse her for my portion of the premium through that same C Corp? This is an entity that was set up by Anderson Advisors.
So here's what we got. Let's say that your fiance currently has all of her insurance paid for by the employer. Once you get married, you will be on her plan and she's going to have to pay for your portion of the insurance. Now comes in that depends. If the payment, say it's $500 a month, if that $500 a month is going through a pre-tax plan, a 125 plan, cafeteria plan, whatever you want to call it, you're already receiving the tax deduction for that.
Right.
If it's not, if it's just $500 that you have to fork out to pay for to keep you healthy, that $500 can be reimbursed by the corporation. It doesn't matter, it's your wife's plan. Once you get married, you're in this together.
Right.
That's how these accountable plans are treated, and the medical plan is that you are one entity inside this entity. And
you don't actually have to be married to be able to reimburse for her plan. You have to be married in order to benefit from her plan, but you don't have to be married in order to reimburse her from this plan. If she's a officer or director or employee of the C Corporation, she can participate in the plan.
Right.
Anything else to add to that one? I think I'm good too. Okay. Long question, short answer. Okay. Can you explain how to invest in stocks from an LLC? How is it beneficial? How it is beneficial on tax? That CNI dog, I'm telling you. What are our write-offs if we are investing in stocks?
We got to start using smaller words.
So how to invest in stocks from an LLC? Well, number one, you have to set up a brokerage account in the name of the LLC, or you're going to have to transfer your brokerage account if you just have one in your personal name to the LLC. And you're just going to have to contact your brokerage firm if you have a current account to see if it is going to be possible for you to do that.
Have you seen some issues with that though, trying to trade through an LLC or an entity that they want to charge you more money or?
Not as often as you think.
Okay.
But there are some brokerage firms, and we really probably should compile some sort of list, but there are some brokerage firms that will charge professional fees when you put your brokerage account in an LLC because they think that, or they're classifying you as a professional. I just told them I'm not a professional. I know nothing. It didn't work. But anyway, so there is a ways around that, and that is just to use a personal property trust and put the brokerage account in the personal property trust and have the beneficiary of that personal property trust be the LLC. Ultimately, here, what we're looking for when we're investing in the LLC is asset protection. So we need that personal property trust beneficiary into that LLC still. We still want an LLC for our limited liability. And no, we don't think anybody's going to slip and fall on one of your stocks, but you probably will at some point, hopefully not, have some outside liability. Like I think Toby likes to say, you know, if your teenage son driving your car runs over a gaggle of nuns, and you have now your outside liability. If it's in your personal name, brokerage accounts in your personal name, it's going to be up for grabs in any litigation. So we're doing the LLC for asset protection, and how we put that brokerage account into the LLC is going to depend on the brokerage firm. Because again, if you already have the brokerage account in your personal name, if you contact your brokerage firm and just let them know, hey, this is an LLC that's disregarded to me personally, I still retain control, it's going to be reported on my personal tax return, so on and so forth. Just explain it to them. Cannot hear. Somebody saying they cannot hear. Just a quick check. Can everyone hear us? If you can, blink twice. No. Type in yes. Okay, very good. So just, you can't hear me, so I couldn't help you. But
I was waiting for you to explain it to them. Patty or somebody, I think, will reach out and try to give you a little help.
Okay. So going back to the question, if they're going to require you to, if the brokerage firm is going to require you to close your positions in order to open them up back in the LLC, of course, we're not going to recommend you do that. You're just going to start a new brokerage account in the LLC and, you know, systematically start moving things over. There is no tax benefit if you just have a brokerage account in an LLC that is taxed as disregarded or a partnership. To get tax mitigation, you have to have a corporate entity. Okay, whether that means we're just going to have the LLC tax as a corporation, because we can do that too, or that means we're going to have the LLC partner, make it a partnership with you being the individual being the majority partner, say 80%, and the corporation being a minority, say 20%. And that way we're getting our income shifting or income splitting, however you want to say it. So if in that case, we have the brokerage firm, or excuse me, brokerage account, and the tax benefit would be that off the top, 20% of my capital gains are not going to hit my personal tax return. They're going to go up to the corporation. I'm going to be able to take all these lovely tax deductions that I'd be able to take on a corporation that I'm not otherwise able to take on my personal tax return. Like the medical benefits we had someone talking about a bit ago, or asking about a bit ago.
And here's the important thing that Tony brought up much earlier in one of the earlier slides. The investment expenses were deducted under miscellaneous itemized deductions. Those are gone. However, if we have the corporation managing the trading or managing the LLC, perhaps we're giving them a guaranteed payment. We're not giving them a management fee. We never want to do that. But maybe we're giving them guaranteed payment. That corporation can pay those expenses directly, whether it's to buy software or buy articles or whatever it may be, those type of investment expenses, and write those investment expenses off as ordinary expenses. It gets whatever payment they're receiving from the LLC.
Yep. And we have someone in the chat I'm going to feed into it, even though we want you guys to ask your questions in the question and answer. I can't help myself. New to the term disregarded. I'm new to the term disregarded. Would you please explain it? Disregarded is a federal term mostly, and it just means that for federal purposes, the LLC, for federal purposes, the IRS does not recognize the LLC, and it's just going to be reported wherever it's required to be reported on the owner's tax return. So if you're the owner of the disregarded LLC and you are flipping real estate, I don't know why I chose that.
Proceed.
That's going to go on your, it's just going to get reported on your Schedule C as if the LLC didn't exist.
It basically means that we don't pay any attention to it. It's disregarded.
Mhm.
Who owns this LLC that you keep talking about?
Yeah, it's not, it's an asset protection tool. It's not a tax tool. It doesn't become a tax tool until you elect a corporate status.
Disregarded LLC is always going to be a single member LLC.
Mhm.
Once you add a second member, it's a partnership or something else.
Unless you're married filing jointly in a community property state. You hate me, don't you?
I like it
Okay.
because I have to.
All right. So what are our write-offs if we are investing in stocks? So it depends. If we're treating this as a business activity and you've gone ahead and you now have the LLC is taxed as a partnership with the corporation being one of the partners. Now you've spun off this corporation into an actual business that is in the business of managing other business entities like our LLC. It's the managing member of the LLC. So that's what it's in the business of. So now as that managing member, I'm going to be writing off any mileage concerned to any travel I have to do related to the activity of managing my cell phone expenses, my internet expense, my administrative office, so on and so forth. You know, ordinary business expenses is what I'm doing in the corporation. I see LP managed by a C Corp. It's not an LP. An LP is a limited partnership, and that's not the direction you want to go in. It should be an LLC managed by a corporation, unless of course you already have an LP. If you do, it's perfectly fine. But
the LLC is the preferred way to go now.
Preferred, yeah.
Since the TCJA, Tax Cut and Job Act.
Correct. I think that takes care of that one. What do you think?
Yeah, one of the examples in the good old days, some of these brokerage firms would charge thousands of dollars a quarter, a month for advisor fees. And people would write them off and under miscellaneous deductions on their itemized deductions. Well, since we can't do that anymore, what we can do is throw those fees onto the corporation.
Yep, exactly.
And allow the corporation to deduct them.
And we have someone else saying, when you say LLC tax as a corporation, do you mean S election status? I do not. I mean C Corp. And
I had to learn to do that.
What?
I would either say S corporation or corporation. And I've noticed a lot of people, a lot of our clients said S corporation or C corporation. So I had to kind of push myself in that direction.
Clarify, yeah. All right. Was that it? Nope.
No. No, we are not done. This is what we talked about earlier about subscribing to Anderson Advisors on YouTube. I think we're on Apple Play or whatever it's called now, and a couple other. But there are tons of educational videos out there for you to look at. I think Clint's producing 1 hour, or maybe it's not that much.
All right. Can I use an S Corp to serve as a management company for my real estate investment if my real estate is held by a Wyoming holding LLC and Illinois single member managed LLC? Are there tax benefits to this strategy?
Well,
so let's set the stage. Let's set the stage. And the stage is, so everybody understands, what we're assuming you're doing is an Illinois single member that's holding the property, and that single member is disregarded to your Wyoming Holding LLC. Next question is, or the question is, can I use an S corporation as a management company for, it's really for the Illinois single member LLC, because that's the LLC holding the property, but go ahead.
Yes, you can. That doesn't mean yes, you should.
I love you, Jeff. We are of one mind on this one. Go ahead.
Yeah, when I see using, especially from a disregarded entity and using a S corp for a management fee, they're basically doing this, they're taking money out of this pocket and they're putting it back over in this pocket, and nothing has really changed. That's why we recommend using the C corporation, because the C corporation isn't you. The S corporation is. Where you might use it if you have multiple members, maybe the ownership is not exactly the same.
I would really only use an S corporation if I was doing property management for properties I don't own.
Yes.
But if it's a property I own, I'm usually going to recommend a C corporation for the exact same reason that Jeff is referring to there. Here's the rub. So S corporation can take a lot of, not a lot, it can take some of the same deductions a C corporation can take. All right. So you can have an accountable plan in an S corporation, because S corporation is considered a separate taxpayer where you're concerned, because you're going to be paying yourself W-2 from it. So S corporation can have an accountable plan. So it can reimburse you for your out-of-pocket expenses. It can do the Section 288 meeting room expense deduction. It cannot do the medical expense reimbursement. I say it cannot. I never actually seen anything that says it cannot. But here's what, okay.
It's an exception to the 2% owner rules.
Let's lay the stage. If you did do it, let's say you did have a medical reimbursement plan in the S corporation, and the S corporation is reimbursing you and deducting medical expenses. Okay, well, S corporations, like partnerships, have to have separately stated items, right? So it's just going to be Schedule K, separately stated item, going to flow through to your personal tax return onto your Schedule A, and just took the long way around to be subject to that 7.5% floor limitation on the medical expenses, which is why we don't love it. And we want to take those medical deductions on the corporate C corp tax return. All right, so let's just say, for argument's sake, I use my S corporation, I did my accountable plan expenses, I did my 280A, we can do medical insurance premiums through the S corporation, you have to add it into W-2. All right, let's say I did all that stuff and I have, it totals up to $20,000. I could do a management fee to the S corporation of up to $20,000 and make it a wash. No income is flowing through to me personally, because it was net zero. Okay, you either want it to net zero or a loss. And what happens to S corporation that shows losses 2 out of 5 tax years?
Oh.
So, don't love using the S corp, and you also don't want to misstep and end up with positive income flowing through to the S corporation, just for like what Jeff was talking about. You're just taking money out of one pocket and putting it into another pocket. Especially in the case of rental real estate, you've now taken passive income and turned it into active income that's required to pay you a reasonable salary. So you've potentially added payroll tax to it. So for a number of reasons, there aren't really any tax professionals, at least none that should be still remaining in this building, who would recommend doing an S corporation over a C corporation. But can you do it? Yes. Where it has its place is if you are managing properties, or anything for that matter, that's not your own. All right. You can see why I picked that one, the passion.
I do. Need a tissue.
Oh, thank you. Next question. If I have an S corp, can I use a combination of Section 179 and 168 K okay, for equipment or business vehicles?
Okay.
I guess we probably should start by explaining what 179 and 168K are.
Yeah, 179 is the election to expense certain items, newly purchased items. 168K is what we call bonus depreciation that allows you to write off tangible personal property in the first year if the life of that property is less than 20 years. Now, here's what it comes down to. With the exception of a few states where they're a little quirky with 179 and bonus 168K, bonus is going to take care of almost everything.
Mm-hmm.
There's really no reason to use 179. 179 has more limitations than the bonus depreciation does. And that will continue to be true until 2023.
Yeah, and TaxWise on Friday, Toby was asking me, under what circumstance would one use section 179 over section 168K? It's like when 168K starts to phase out of its 100% bonus depreciation, then 179 might start looking a little bit more attractive.
So let's say we're in January of 2023, the 100% bonus is sunsetted.
Mhm.
Is that a word? Okay. And we're looking at 50% bonus now. Then that's exactly when you're talking about, I'm going to take bonus of 50% on this new piece of $100,000 equipment I have. So I get a $50,000 of bonus depreciation. The remaining $50,000 I hit with 179.
Seemed
Now-
like you were sprinkling it with 179, but that's okay.
And one of the things with 179, let's say we're doing that. So I have $50,000 of 179. I also have to have $50,000 worth of profit in that company before I take
Yep.
profit. That's one of the rules for 179. You can only take it against your business income.
And the question is, if I have an S corp, can I use a combination? So it's not necessarily a matter of whether you have an S corp. Section 179 and 168K is available to S corporations, C corporations, individuals, whomever. It just depends on the asset. So yeah.
Yeah, 168K is more flexible than 179 in almost every way you can think of. 179, we've talked about in the past, if you distribute something to yourself, there may be tax consequences of that. You have to look at how it flows through to you directly.
Yeah.
And that's not, from my reading, that's not, that doesn't happen with bonus depreciation.
I've not seen it. No. All right, let's keep it rolling. Bonus depreciation for the vehicle.
Vehicle is subject to it, but there's going to be those limitations based on 280F.
Okay, but that's not what we're
Luxury auto limitations.
All right. Is it better to file married jointly or separately? What say you, Jeff?
Almost always, not always, but almost always, it's better to file jointly. The tax breaks are better. The brackets are supposed to be right in the middle. So if I have a $100,000 tax break here, then it breaks 50-50.
Yeah.
But on the other side, there are certain things that just go away or are limited drastically, whether they're retirement contributions or student loan repayments and so forth. You lose the tuition credit. So I've only seen it in a couple of states, Ohio being one of them, because they have a joint filing credit. Somehow it works out that it's sometimes better to file separately in that state.
It's always better to file separately when your spouse is engaging in criminal acts.
True. If your spouse has also generated a lot of tax that you didn't know about, unpaid tax.
Yes.
You may want to file separately under the innocent spouse clause. There's two of them, innocent spouse and
Injured spouse.
Injured spouse. So if you want to avoid your husband's, wife's, spouse's tax problems, you can. I'm not sure if it works in community property states as well. We'll leave that for Toby.
Yeah, we'll leave that for another day. But, you know, it is true, because your spouse is going to have to report their ill-begotten gains if they are engaging in criminal activity. However, you're not allowed to take deductions against that income. So for that and obvious other reasons, probably should file separately under that occasion. But to Jeff's point, if you're both law-abiding citizens, then 9 times out of 10, married filing jointly is going to be the best way to go. Next one. Is it better for a single member LLC to file taxes as a disregarded entity or as a partnership, and why? Actually, Jeff, you touched on that a little bit earlier.
It is always better for a single member LLC to file as a disregarded entity because it can't file as a partnership. It's only got one member.
Oh, but that's not how I read that.
Um,
Because if you're talking about, and this is why I chose it, if you're talking about a married couple,
Okay,
spouses, and
you're good at the supposing part.
I answer platinum questions. Only the ones that you guys are getting out in the 2 to 3 business day turnaround time. Those are me. Let's see. If you are in a single member LLC and you're married filing jointly in a community property state, you have the choice between being a single member LLC or a partnership, or disregarded LLC or a partnership, I should say. If you are married filing separately, or if you're married filing jointly and you're not in a community property state, you have to be taxed as a partnership unless you work your way around that by using a living trust. But why is it better one over the other? In one instance, it helps to clean things up a little bit for you on your personal tax return in the event that you're being asked to show the personal tax return. It's not going to list every single one of your properties. Let's say you're a real estate investor. It's not going to list every single one of your properties on the Schedule E, because all of those properties are going to be on the partnership tax return. That's going to be separate. Also, to a point Jeff was making earlier, it makes you better lending wise. So if you have a lender looking at your tax return, especially in commercial lending, and they're looking at Schedule E page 1 versus income flowing through a partnership, which is on Schedule E page 2, you'll get somewhere between 70 to 80% on the Schedule E page 1, whereas you get 100% on the Schedule E page 2 partnership.
I don't know why, but that's the way it works.
Well, they just don't know. They don't know if they're looking at the Schedule E page 2, they don't know it's real estate. All they can see is whether it's a partnership or an S corporation, and whether it's passive or non-passive.
Right.
But they don't know it's real estate. If it's on Schedule E page 1, they know it's real estate and they treat it less favorably. And that's the part I don't know. Why. I know real estate's not as favorable. I'm not sure why it's not as favorable, as in their mind, Schedule E page 2 is a business activity. I explained the difference. Did I say why? Yeah, I think I did. Yes. I think that's it, guys. That's all of our questions we have for today, I believe.
So that's a link to some of our podcasts. Hit the next one. And there you can see, can you see them? I can't see.
No.
The print is really tiny.
It just is illustrating some of the podcasts we have available to you, with Tax Tuesdays on there. We've got Eric Dodds, who's one of our financial planners, is on there. Clint's on there. Greg Boots has some content. I can see the pictures. Is on there, so you can catch a lot of good content. Yes.
And I'm gonna hit this for you. Replays are in your Platinum portal. And the reason I wanted to go with this is you can see so many Tax Tuesdays, and I'm sure it's the same for some of the other podcasts we do. There's a certain number. I think if you're a Platinum member, you can see all of them.
Oh, yeah. If you're a Platinum member, you go into the Platinum portal, go into our video content, you'll see all of the replays of Tax Tuesday. Just scroll through from mine. And you can see the replays of Tony Talks, Coffee with Carl, all of our fantastic contents there. There's also a frequently asked question area for you. If you have questions, which I'm sure you guys do, because you kept our guys busy today, we answered 139 questions and we still have 26 hanging out. You can, if you didn't get your question answered today, you can go ahead and send those to Tax Tuesday at andersonadvisors.com. And we will come back here in another couple of weeks and answer some of those questions for you. You can visit our website at andersonadvisors.com and peruse that. It says email or visit. You can submit Tax Tuesday questions on the website.
You can through the, I don't think you can submit questions directly through andersonadvisors.com, but you can email them in. And we'll either answer those during Tax Tuesday or answer them straight to you. I know we do have some people trying to answer those questions that we send in that may not get asked during Tax Tuesday. We appreciate the time you spent with us. Toby will be back next 2 weeks. And
Next time.
I appreciate you sitting in for him. It was fun to do.
Yes, unfortunately, you guys, this is not going to be ongoing. Toby will be back. But you can, I have someone asking as a platinum member, what number do I call in for the daily call? It's not a call and you're going to go on the platinum portal and in the middle banner, you'll see a hyperlink to log into our Zoom call. 4 to 5 Pacific, Monday through Friday, with the exception of holidays.
You're late.
All right. Thanks so much, guys.
Thank you.